Hello and welcome to today's live stream. So, got an exciting one today. This is going to be on all things UK and Dubai. So, over the years, we've sold a lot of Dubai property and obviously a lot of the UK property. Now, I've worked on and off in Dubai since 2014, so I know the market exceptionally well. And obviously, I've got a track record in the UK as well. But there is a big crossover for property investors. I'd say, especially probably since COVID, Dubai really started to uh, increase in popularity and demand. Obviously, it was quite an active market before then for British investors. Like the UK buyers have always been big investors in the UAE, in particular Dubai. But since COVID, it really started expanding and got the popularity for a number of reasons. So today I'm going to go through the advantages and disadvantages of both the UK market and the Dubai market. So you can effectively weigh up what you think is most suitable for you. I've got the key points on my screen here. We'll wheel through the UK first, and then we'll go on to Dubai. And we'll, as I say, we'll look at the pros, the cons, some stats, and I'll give you my personal insights into what I think as a property investor you should be considering and yeah, really help you make an informed decision. So we should be good to go. Let's get it cracking. I am going to start with UK advantages. So the long and the most important one for me is the long-term stable capital appreciation. So if you go onto the land registry, I think records began in about 1960, maybe just before that, but I always tell people, and I've said this on a previous live stream, the most important statistic you need to look at for the UK market is simply the appreciation rate from when records began until now. And it's very linear. It's almost like that when you zoom out and look at the macro data. So that's a really, really important one for me. We've got a stat here, the office for, just adjusting my screen slightly. Cool, that should be better. So yeah, the Office for National Statistics stating that between 2013 and 2023, the appreciation rate on average across the UK was 74%. Okay, so pretty significant, not quite double. We used to see double, used to be a bit of a saying that your property would double in value over 10 years. So not quite that, but that's looking at the average across the UK. So very low turnover, low performing markets are included in that. But as a nation, for a average figure of value rises, that's very, very high. So yeah, the decades and decades of capital appreciation, slow and steady, is what I would see as the number one advantage for the UK. Secondly, strong tenant demand. So the reason why rents increase so much in the UK and why, again, there's stable rises there is because of the demand for assets, especially in city centre, but to live in, to rent. So affordability is getting more difficult. People are not buying like they used to. Everyone knows family members that, got on the property ladder nice and early. That is decreasing and it's happening rarer and rarer. People are buying homes later in the UK. So there's a huge, huge demand for rental property. And as a landlord and a buy-to-let investor, obviously you're primarily purchasing the property to rent it on the open market. So having a strong tenant demand is a massive, massive advantage in the UK. And yeah, that's not going to change anytime soon, especially in the city centres. Look at the prices in London, even Manchester now, Birmingham, Leeds, Liverpool, they're all seeing massive, massive demand for rental property. A good one to check for that is the Office for National Statistics, where you can see the past 12 months performance of rental value rises in your particular location. Might be at city level, at borough level, you can type it in and you can see the exact data. Also, Home Track do a great report quarterly, rental price index, so you can see current performance of where's doing well, where's seeing a lot of demand, what's happening in the rental market. They're probably the main two I'd look at. And then for the future, JLL do city level for the major cities rental price forecasts of how much they think it's going to increase by. So you can use that to make informed decisions as well. So yeah, strong tenant demand is another big advantage of the UK. Mortgage deposit levels. So in a lot of international markets, you do see higher rates for mortgages. So even if you're a international investor coming into the UK, you can often get 25, 30% deposit levels. So 75, 70% loan to value rates, LTV rates, which means you're keeping your deposit level relatively low for a buy to let purchase. If you look at Dubai, typically that might be 40 to 50% deposit required for a non-resident investor. Now, the ticket prices, or in other words, the purchase prices in the Dubai market increase aggressively, and we'll talk about that later. So to get a decent property there, you are looking, £200,000 plus now. So you're talking, you're probably going to need half of that at least when you consider your purchase costs, etc. So you're talking quite high levels of cash sums that are needed to enter the Dubai market, which you don't need as much for the UK market. So yeah, lower deposit levels required for mortgages for both residents and non-residents is certainly an advantage that I see. Mature legal structure. So we have a really, really robust, well-regulated legal system in the UK. Obviously, solicitors are used for nearly every single purchase or conveyances. We understand where we stand as a tenant, as a landlord, as a leaseholder, as a freeholder. It's all very well documented, and a robust system is in place in terms of the legal side of things. And the UK is ranked among top countries globally for property rights. I think it's top 4. And that was from the World Economic Forum. So yeah, keep that in mind. A robust, mature legal structure, so we know where everyone stands. And the one thing I would add to that as well is you can resolve issues relatively promptly in the UK market. We have various services available, but small claims court, your property agents are required to be members of a property redress scheme in the UK, which can resolve issues very promptly as well. And you do have, mediation, and obviously going to various courts as well. So yeah, mature legal structure is another good one. Strong mortgage market for investors. Now, I've mentioned this one separately to the deposit levels because the ability for people to get mortgages in the UK is very, very strong. When you're looking at the buy-to-let model, they're very much stress testing the income from the property, how much cash flow is in it, how much almost margin is in it on a monthly basis. So that gives both resident and non-resident investors an opportunity to get into the market quite easily with affordable interest rates and a wide range of mortgage products available. So that's, really, really attractive. Over 2,000 buy-to-let mortgage products are available, and that's a source from Money Facts. Keep that in mind. So yeah, there's a few for you on the advantages side of the UK. So long-term stable capital appreciation, strong tenant demand, low deposit levels, a mature legal structure, and a wide range of mortgage products. Disadvantages. What are some of the drawbacks of the UK market? So we've it's almost going to be the opposite to the advantages. But in this case, if you look at the appreciation rates, it's very much a slow and steady market. So if you're a very risk-on investor and you don't mind rolling the dice and getting into markets and coming out and trading property, then the UK market as a slow and steady crawler, so to speak, is might not be the one for you, because it's very much 4 or 5% capital appreciation per year is very typical in markets. Probably over the past 12 to 18 months, we've seen a lot of 2-3% rises. Now it's getting up to 4 or 5%, which is good to see. But nationwide, Building Society quote 3 to 5% annually as being a stable rate across the UK. So yeah, slower appreciation, increasing regulation. This is almost in every segment of the market. A lot of it caused some people to say the buy-to-let market is dead. It's difficult for property developers with planning. And yeah, it's just regulation is a burden in the UK. There's no two ways about it. And there's a new law coming in, or range of regulations, called the Renters Reform Bill, which effectively puts a lot of power in the tenant's hands, with notice periods, with evictions, with Section 21 removal. And it just creates a bit more of a hesitation and another barrier and another loop for buy-to-let landlords to jump through, which is a bit of a pain. It's not like a huge impact on the market. There was a lot of negative press around it when it first came out. But when you sat down and looked through the regulation, it wasn't perhaps the big sting that a lot of people thought. Nevertheless, the big one for me is just a notice period for tenants when they can leave contracts. Now you're all on, landlords used to buy a property and go find a tenant for 12 months and go, right, I'm locked here for 12 months now, I'm fine. and often they might stay or renew for another 1-2 years. Now the tenants have the ability to leave. I think it's with 1 or 2 months notice. So that certainty and that predictability of having that tenant in place for 12 months is effectively gone. So it does create a bit of more exposure for the landlords in terms of void periods. So keep that in mind. Regulation, it is a bit of a pain, but as long as you research well, you've got a good managing agent in place, then you should be well prepared for that. Tax, obviously, that is a very, very big one, especially for non-resident investors. A lot of UK investors are kind of used to dealing with tax in the UK because they're paying huge amounts of it from when they start working. So not such a hit. However, what I would mention is stamp duty rises. We've seen that. Corporation tax rises. We've seen that. Income tax hasn't been too much of a change. But so that's for residents. They do understand and have to buy in a company name to mitigate that tax exposure. For non-resident investors, it's a big one because you get the surcharge on the stamp duty land tax now, which in other words means when you're buying a property, you have to pay a lump sum of tax. Used to be a lot lower. Now there's a surcharge for non-resident investors of 3%. So that's quite a hefty amount. You know, some of these properties, when you're buying in London and you're buying a non-resident investor purchasing a buy-to-let property in London, you're going to be paying tens and tens of thousands of pounds in stamp duty. It's really, really quite significant. And that doesn't include taxes such as inheritance tax, capital gains tax, etc., etc. So just what I would say around that is just make sure you're planning appropriately. You're negotiating the deal. You know, you make your money when you buy the property, not during the ownership is kind of an old school cliche in property. But in other words, make sure you're negotiating if you're buying from a developer effectively. If you're buying on the secondary market or from an end user, make sure you're trying to haggle and get them down as much as possible. Do the appropriate planning with tax. Speak to a qualified accountant. Make sure you're utilizing all the benefits, writing off relevant expenses, tax planning in terms of withdrawing capital at the right time, making sure you're loaning money to the company effectively and withdrawing dividend payments in the right structure. All these little things you've got to plan. There's no room for luck or chance anymore. So get the relevant advice around tax, but that is a big disadvantage of the UK. Short-term let restrictions, and I've written here as well, HMO restrictions. So things like Article 4, where you're going into or where you're buying a HMO property, so house of multiple occupancy. In other words, you have 4, 5, 6 people in there, all sharing communal facilities such as kitchens, but they have their own room typically. In some places now, you need to get planning special permission for that from the local authority, which is called Article 4. It's good if you've already got a HMO because it restricts the further HMOs coming to the marketplace and reduces your competition. But it is a pain if you want to be a HMO investor, or you've got, again, just more regulations, more loopholes to jump through. And short-term let restrictions in the UK, you do need, or in England, you do need approval in the lease to operate a short-term let model. And not all developments have that. So again, it can be good. It does, if you do get that in your lease, it does differentiate your property for when you come to resell it and can potentially increase the value. But it is more restrictions. So HMO restrictions, short-term let restrictions are things to keep in mind. And limited supply of quality new builds. So this really becomes apparent when you compare it to Dubai, which is fundamentally the purpose of this live stream. So when you look at the UK, there's a lot of happening at the moment. A lot happening at the moment in terms of what we call PD development. So permitted development rights. In other words, less planning permission required from converting an office building to a residential apartment. But a lot of these office buildings, they're not really set up to chuck in, huge communal areas of gyms, co-working spaces, certainly not swimming pools. The products in the UK in terms of property developments, they can be a bit plain unless you're paying a super premium for, these facilities. So yeah, that's the kind of disadvantage of the UK. So slower appreciation, increasing regulation, tax, short-term let restrictions, HMO restrictions, and limited supply of like special products or really standout premium grade products. Cool. So that's the UK. Moving on to the Dubai market, advantages. So capital appreciation, a kind of disadvantage as well as advantage. But you look at the appreciation of the Dubai market and it's exceptionally aggressive. Okay. It's why money from all around the world is going into Dubai because the values are rising so fast. Not in every single area, but I think it's fair to say in the majority of medium to super popular areas, the appreciation rates are very attractive in Dubai. So if you look at the Dubai Land Department, the average prices for 2024 rises was 17.4%. But it's not uncommon to see areas rise by 25, 30% in a year in Dubai. And you compare that to 3 to 5% in the UK. There's a possibility you could get 10x from investing in the right location in Dubai at the right time in comparison to the UK. Doesn't always happen. Dubai is very volatile and it depends on the supply coming to market, the demand in that area, big press around that area, new announcements in that area. So it's not a case that everywhere does it, but without doubt, you look at the Dubai market, the appreciation rates are phenomenal. Some of the best in the world. I think Knight Frank a couple of years ago named it as the best in the world for capital appreciation. Higher rental yields. So again, since COVID, we've seen an influx of population. You probably know people that have moved to Dubai, that are moving from all corners of the globe. And as a result of that, the rental demand is strong because obviously not everyone can afford to buy immediately. So that puts upwards pressure on rental rises. Rental prices are controlled in the UAE from RERA, which is the governing body effectively. So owners cannot just suddenly hike prices. They have to be in line with the market value. And I believe it's a 5% margin that they can put on that, or 5% increase at any one time, something like that. But yeah, there certainly are restrictions and your managing agent will make you aware of that. So yes, there are naturally higher rental yields in the UAE market or Dubai market, but you do have to be careful of the rental rises because it's somewhat prohibited. So short-term lets, friendly. That's another one. In Dubai, obviously there's a lot of competition from hotels, and in buildings where there's hotels attached, etc. There's often restrictions put on place for short-term lets. But other than that, you can get yourself a license from the Dubai Department of Tourism, and you can just rent your property on the Airbnb, on Booking.com, on the short-term let market. So there's no lease restrictions and bits and bobs like that, like there is in the UK. So a lot more opportunity for that. And apparently there's 30,000 licensed holiday homes in Dubai, according to the Dubai Department of Economy and Tourism. So yeah, it's a proven model. A lot of people do it. Just go on Airbnb and look at the prices that you pay and you'll see it can be very, very lucrative. High quality developments. I do mention this one because you buy a 300 grand apartment in Dubai versus a 300 grand apartment in the UK, you're getting an entirely different finished product. So in Dubai, you're going to get a free car parking space. You often get a swimming pool. It's almost a given now. You get a swimming pool, co-working, gym, not box gyms, good sized gyms in some of these buildings. It's just a phenomenal product that you'll end up with. And as a result of that, it will be somewhere that you would be happy to rent on the open market. My camera's just switched off. Just give me 1 second. Did this last time before. I think it switches off after a certain period of time. Let me just see if I can get that back on. There we go. Cool. So it should be good to go. So yes, the people used to say, I would only buy somewhere that I want to live in. So go move all my wires out of the way. Only buy somewhere that you want to live in. So yeah, when you're buying in Dubai, you're buying a really, really nice high-end product. If it's an apartment or a villa or a townhouse, they're all very often very, very nice. So it can be somewhere that you'd be proud of. And that moves on to the last point. You can combine the fact that you have short-term let approval and a really, really nice property. You can combine the financial investment with the fact it's a lifestyle investment as well. So you can go there, you can get family members go and stay there. You can go there, use it as a holiday home a few times a year, or escape the the UK in January, or however you want to go about it. But yeah, lifestyle investment is another advantage of the Dubai market. So stronger and aggressive capital appreciation, naturally higher rental yields. It's short-term net friendly. You get a high quality build from the developers themselves. So very reputable firms, some of the billion, dollar companies publicly listed. As a result of that, they build very high specification, high quality products, 5-star hotel standard. And the last point, you can, as a result of those previous points, you can make it a holiday home or a lifestyle investment, so to speak. Cool. So disadvantages of Dubai, a couple of things to be aware of. Volatile market. No doubt about it. Dubai is exceptionally volatile. You've seen with the Iran war, the price of, well, you might not have seen, but values in some areas held up well. Some of them decreased aggressively. There was reports of a 30% drop in some locations. Take that with a pinch of salt. I think obviously with transaction levels declining, it's probably more of a short-term effect than a long-term sustained effect. I don't think the fundamentals of the marketplace changed. I think when the war's finished, a lot of people will continue to move there. Developers aren't all of a sudden dropping their prices aggressively. There's not really a huge supply of distressed deals coming to the market from what I've seen. I'm not directly involved in the secondary market, but certainly there's no panic selling. I think there was an initial spree of transactions, but I think that's about it, really. However, when you zoom out a bit and you look at the macro level, got a stat here from Knight Frank showing that prices fell between 2014 and 2019 by 35% on average. So again, that's not the core areas. So I guarantee that data is not from the likes of downtown Dubai, Dubai Marina, Dubai Hills, Palm Jumeirah, etc., etc. The hotspots in Dubai they perform so well, and I would say they are now. I don't really think you can call those emerging areas now anymore. They're very mature, huge amount of capital in them. So that is you take with a pinch of salt. But overall, if you look at the market, it can be very volatile. Which is, by the way, that's a pro and a con. Same with crypto, right? Sometimes you have aggressive rises, sometimes you have big drop-offs. You just have to keep that you have to take that into account for the Dubai market. Large supply pipeline. So you do have to be careful. There's 120,000 units expected by the end of 2026, according to JLL. So what you've seen in recent years is experts from Dubai say put more of your focus on things like townhouses, villas. Waterfront villas are the pinnacle of investing in Dubai. Those types of properties are in huge supply. People want space. You've got more families moving to Dubai. There is few of them being built in comparison to apartments. I would assume so because they are less profitable. The price per square foot and the margin the developer's making on the overall gross development value is probably smaller in townhouses and villas in comparison to building a huge tower and cramming 500 apartments in there and selling them for 300 to 600 grand each. So keep that in mind. There is a large supply of apartments coming to the market in Dubai. So don't buy mediocre locations. Don't buy tier 3, tier 4 locations. Don't get sucked in by a good payment plan and a low price just to get a deal and get a very average product, because you will suffer with the tenancy demand. Just keep that in mind. High deposit levels. So for non-residents, you're looking at 40-50% to enter the market. That goes for the mortgage side and with the developers, what the developers request as deposit level during the construction period. So that's something really to be aware of. Some of these developers, I remember when Imar Beachfront was one of the phases were released, and they were asking for 90% cash during the construction period. If you were to try and sell that to a UK investor in the UK market, you would be laughed out of the market. And to be honest, anything above 25% deposit in the UK from the developers, of which they're requesting during the construction period, is kind of a no-go. Even 25% is a little bit of a challenge sometimes, depending on the location. And you've got these Dubai developers that are asking for 80-90%. Okay, 50% is very common in Dubai. So it's a cash heavy market investing in Dubai. So you've got to be liquid. So higher deposit levels is a disadvantage. Less structured buying process. I mentioned this one just because UK investors are so shocked sometimes, because there's very rarely solicitors which are used or conveyancers used during the purchase process for off-plan or what we call primary market deals in Dubai. So if you're an investor in the UK and you want to buy in Dubai, you go to a developer, you work with an agency, you identify a unit, and then you start the purchase process. So firstly, you have to pay a load of cash straight away for the reservation fee or booking fee. with minimal documentation. Sometimes they just send you a link and say, pay 10 grand here. Once you pay your booking fee, you'll then be sent what's called a SPA, a sales and purchase agreement. Now, what will happen in the UK is that's sent from the developer solicitor to your solicitor who's representing you. Your solicitor will then go through that documentation and do what they call raise inquiries. So they'll go through it, they'll check it all, they'll have a list of questions, they'll send that back to the developer solicitors, which is known as raising the inquiries. The developer solicitor will answer them. That will go back to the solicitor will sign out. They'll then create a report, they'll send that to the buyer, aka you, the buy-to-let investor, and that's being called reported out on, which means they've summarized all the information, they've explained the points to you, and they've asked you to exchange contracts. That's what happens in the UK. When you're happy, you pay your deposit. In the UAE, the developer will send you one contract and you either sign it or you don't. It's that simple. That contract is called the SPA, Sales and Purchase Agreement. So there's no solicitor involved, your side or their side. They'll send you one document. You can't edit it. You have to sign it, send that back with 50% or whatever the payment is. Technically, the down payment at that time is normally around 20%. But it's just such a big shock when you've got UK investors that they've got 4 properties in the UK. They've often, without sounding harsh, they think they know it all. They think they know the system, the game. They say, yeah, I fancy a bit of Dubai. I like the fact I can get a property over there. One day I might even become a resident and get tax benefits. But until then, I'll go and use it as a holiday home. I'll get my free parking space. It's a freehold purchase. I can get an 8, 9, 10% yield on the short let market. Then you tell them that, oh, by the way, there's no solicitors used in the process. They normally have a hissy fit. So, it can be a disadvantage. So keep that in mind. Especially for, if you've got to think of high net worth buyers, institutional buyers, obviously they're going to have their set legal team. So maybe it doesn't apply as much, but probably for high net worth individuals that are sitting on a couple of million quid, they're going into the Dubai market. It can be a shock when you tell them there's no compulsory requirement for solicitors, or more so, even if you appoint your solicitor, the chances that the developer will edit the SPA to your requirements are very, very rare. A lot of it because it's approved by the governing body RERA, who I mentioned earlier. Cool. So less structured buying process is an issue. And just lastly, developer delays / customer service. This will drive you absolutely insane at times. So yes, the Dubai market has matured a lot in recent years. There's been a huge amount of regulation that's come into the marketplace, and fair play to them for that. It has tightened up a huge amount, and a lot of the times now it can be a lot safer than the UK, especially when you consider that all these developers, they need to either have completed a certain amount of construction or committed capital and put it in an escrow account prior to starting to sell, or in addition to that, they required developers to use escrow accounts. So investor funds are always ring fenced, and then the developer can draw down on them. So that doesn't always happen in the UK market. So that is a great advantage. However, the downside is they do have 12 months to from the projected completion date to finish the build without penalty. I believe that's still the regulation that applies. So in other words, in the UK, if you give a practical completion or an estimated completion date for practical completion, it might be a quarter. So you might say, look, this development is likely to finish in Q2 2028. Can't guarantee it, but it'll probably be in and around that time. In Dubai, they will do that, but then they'll finish 10 months later. And that's very, very normal. Okay, it's very normal. Some developers, Bengati, for example, they might deliver ahead of schedule. They're quite renowned for that. Other developers probably get in and around that time, Imar, Damac, Ellington, and then there's others who I won't name who you can be waiting a year or 2 years past the date you expected it to be delivered. So that is a huge disadvantage. And not only that, sometimes a lot of these developers and agencies, their customer service skills are absolutely diabolical. You can email them for weeks on end and not get a response. You can call them, they won't answer. You get blunt, very concise email responses, one sentence, and if you reply back asking for clarification, it will take you another 3-4 days to get a response. At times it drives me absolutely insane, because obviously, I'm dealing with developers there, other agencies, management companies, lenders, and it can, even investors, sometimes local investors, it can be a bit of a nightmare. So you do have to keep that in mind. The level of professionalism in compared to other global markets is not quite there yet in the UAE. Some things are lightning fast and the services are unbelievable. Like, for example, some government services, like, visa applications, for example, government services, very succinct. A lot of it's online now, extremely professional. You go to one of these centers or you do it online. It's very, very easy to do. Hospitality is another one where you've got some of the world's best hospitality in hotels, drivers, airports, etc., etc. Property professionalism, in my opinion, is nowhere near that level yet. Well, it's not just my opinion. A lot of people believe that. So, yeah, bit of a pain from developers and from agencies. A stat from here from routers: 30% of projects historically delayed. So yeah, almost 1 in 3. So keep that in mind. So disadvantages of Dubai: volatile market, large supply pipeline, so a lot of competition for your unit, high deposit levels both from developers and from lenders, less structured buying process, so no solicitors typically used, and developer /customer service can be a pain, and I won't swear, but can be a pain. Okay, guys, so I'll wrap it up there. Just been going on for about 30 minutes now. So hopefully that gives you a bit of a snapshot, bit of an overview to the from the UK to the Dubai market. As I've just given you pros and cons, I'm just going to give you a quick 1-minute response of my opinion of what I would advise you to do if you're considering the UK and Dubai. If you have a substantial or a reasonable portfolio in the UK, your three and above properties, buy to let specifically, in the UK, Dubai can be a great place for diversification. If you've got the cash, you've got the budget, you've got your foundations in the UK, and you want to roll the dice and you want to get into the Dubai market and get yourself a holiday home that you and the family can visit, Dubai can be phenomenal. Really, really good choice. Or, like a lot of people, if you've had enough of the UK political environment, safety, tax, etc., and you want to relocate to Dubai, then obviously that can be an incredible decision. I've done that myself multiple times. However, if you are new to buy-to-let investing and you've seen tax-free, you've seen the flashy lifestyle of Dubai, and you think, right, I want to invest there and get my first property there, be very, very careful, because you need to put in a lot of cash, which that cash will go a lot further in the UK. E.g., you could probably buy 2 buy-to-lets for the price of 1 in Dubai, not given the ticket price, given the equity required. Obviously, Dubai is more volatile. You've just seen that lived out in real life. So you are taking more of a gamble. If you're an entry-level investor, as I touched on, there's a huge amount of supply for that lower end of the market. So the competition, the void periods, if you're not well educated and you're buying the wrong area or an undesirable area from the wrong developer, you can be left waiting for years for your product. And when it does arrive, it might not get the rental yield or the occupancy rates that you expect. So be very, very careful. So experienced investors, lifestyle investors, and owner-occupiers, Dubai is phenomenal. Great diversification play. Really good chance to earn higher income and diversify, as I say, and support your UK portfolio. Entry-level investors, just stick to the UK, get a buy-to-let for 200 grand in Liverpool and Manchester, put in your 50 grand, set up in a company name, and get used to the market and build up your portfolio. Give it 4 or 5 years, pull equity out of that one, roll into another one, and then you'll be hopefully saved up more capital in the meantime. And then maybe for your third, you can look at the Dubai market. But it's a matter for you. Your choice depends on your risk profile, your budget, your circumstances, your lifestyle, your existing portfolio, your financial position, your lending ability, etc., etc. But I'll wrap it up there, guys. Any questions, let me know. Contact details in the description, and I'll catch you on the next live.